For a long time, trading stocks felt like something you did through a professional intermediary, a broker on a telephone, or a specialized platform with a complex interface and a heavy fee for every single move you made. But by the 2019 and 2020 period, the landscape had shifted fundamentally. Research into transaction costs from those years shows that retail traders were paying significantly less than they were just 2 decades ago. In fact, some researchers suggest that these commission reductions may have functioned as a wealth transfer, shifting value from traditional brokerage firms toward retail clients. This shift was driven by more than just lower costs, it was also about the device in your pocket. Trading moved from desktop computers to smartphone-based apps that made it much easier and more frequent to trade, often without paying commissions. This shift changed not just how we trade, but how it feels to do it. This is where the technology starts to influence behavior. Some researchers have looked at the design of these apps, noting how certain elements can nudge a user. For instance, one randomized experiment found that adding gamified elements, like digital confetti, celebrating a completed trade, increased trading volume by about 5%. It's a small change, but it points to a broader question about whether these interfaces are purely tools, or if they are designed to encourage more frequent, more impulsive action. When you combine that ease of access with the speed of social media, you get a new kind of market phenomenon, the meme stock. This is a social shift as much as a technical one. In January 2021, we saw this play out in a massive, high-profile event involving GameStop. What started as coordinated discussions and trading activity within the Reddit community, our Wall Street bets turned into a massive short squeeze. The stock price surged more than 20-fold, causing extreme volatility and significant losses for several major hedge funds. Some analysts view this through a lens of empowerment, seeing it as a form of collective resistance, a way for individuals to use social news sites and apps to democratize access to market-moving information and challenge the dominance of institutional players. But there is a flip side to that momentum. Some researchers suggest that retail-led speculation, in general, can increase market turbulence and disrupt normal market balance. They point to influences like social media comments, platform games, or the fear of missing out as factors that can lead to trading patterns not directly related to underlying economic trends. To understand how that collective energy actually turns into market movement, we have to look closer at that month of January 2021. It was a period that left the traditional financial world scrambling to explain what had just happened. The target was GameStop, a retail video game company. In January 2021, the company's stock price surged more than 20-fold. For the institutional players, the hedge funds and professional analysts who spend their lives modeling market trends, this wasn't just a price spike, it was a disruption of the established order. But the question that followed wasn't just about how the price moved, but why it moved in a way that researchers noted lacked a discernible economic reason. Researchers have suggested that the surge might be understood through the complex, non-linear interdependence between the activity in the r Wall Street Bets subreddit and the market's reaction. Researchers who analyzed the surge found a striking pattern. There was a significant positive relationship between the activity on that Reddit community and actual trading volume. Specifically, they noticed that within 30-minute windows following certain posts, trading activity spiked. However, the data presents a complicated picture of why this happened. Some researchers have used the concept of social informedness to interpret the patterns they observed. This is the idea that the coordination wasn't necessarily about new, private information, like a secret merger or a sudden profit report, but about the collective power of individual investors sharing strategies and sentiment in real time. It was a form of coordination that didn't look like a traditional investment strategy. Instead, it looked like a social phenomenon. One way to model this is to look at how opinions change in a digital crowd. To explain this, some researchers proposed a model where user engagement can potentially trigger a self-reinforcing mechanism. Imagine a crowd where, as more people start talking about a single idea, the variety of opinions begins to shrink. Researchers have used models to qualitatively compare the stock price hike to a phase transition, a theoretical shift from a wide range of conflicting views toward a more homogeneous consensus. While this model is a way to interpret the data rather than a proven mathematical law, it describes a phenomenon that felt very real during the squeeze, a sudden, massive shift in sentiment that seemed to move in lockstep with the stock price. This creates a profound conflict of expertise. On one side, you have the institutional view, which relies on fundamental analysis. the idea that a stock's value is tied to the company's actual earnings and economic health. On the other side, you have this new, social media-driven reality, where the value of a stock is driven by the sheer, coordinated momentum of a crowd. It's important to be careful with how we label this. It is tempting to call it irrational or uninformed. But the data shows that these traders weren't just acting on impulse. They were acting on the social information being generated within their own community. The information wasn't coming from a balance sheet, but from the collective consensus of thousands of strangers. Researchers have noted that while the posts on Reddit were clearly linked to trading volume, they didn't necessarily provide informative data in the way a news report does. The posts weren't necessarily predicting the future. They were part of a complex, non-linear interdependence between social media and trading activity, where the two are deeply intertwined. For the individual investor, this felt like a way to level the playing field, a way to use collective action to challenge the dominance of the institutions. But for the market as a whole, it introduced a new kind of volatility. It showed that in a digital age, a market can be moved not by what a company is worth, but by how much a crowd is talking about it. But if the crowd moves the market, we have to ask, who is actually leading the dance? For the individual investor sitting at home, the line between a personal conviction and a digital reflex is becoming increasingly blurred. It starts with attention. We often think of trading as a series of independent decisions, but data suggests we are often just following the noise. Researchers using machine learning to track the relationship between social media and trading activity found that attention on the Wall Street Bets subreddit is associated with an increase in the number of retail investors holding an asset on the Robinhood platform. As the intensity of social media chatter increases, researchers have observed a corresponding rise in the number of people holding that asset. This effect is most pronounced in two specific areas: small, niche companies that are easy to hype, and massive, highly visible companies that everyone is already talking about. That momentum can be supercharged if the stock is appearing on a top movers list or if an earnings report is looming. In these moments, the idea to trade might not start in your own mind. It starts as a notification on your phone. Then there are the finfluencers, the personalities who have turned financial commentary into a form of social entertainment. By analyzing 80 million social media posts, researchers found that finfluencer sentiment positively predicts crowd sentiment in the short term. This appears to be a one-way relationship. The sentiment expressed by these influencers predicts the sentiment of the broader crowd without a reciprocal effect. This effect is particularly strong in the world of cryptocurrency and during periods when the market is feeling uncertain. The researchers suggest that during these periods of high uncertainty, the influence of these digital voices on the crowd's sentiment becomes even more pronounced. But even if you aren't following a specific tip or a sudden trend, there is a more subtle psychological pressure at play, the feeling that you are constantly falling behind. In a controlled experiment using a simulated market, researchers looked at how experienced retail investors reacted when they were exposed to upward social comparison, the act of seeing the high-performance returns of their peers. The results showed an association. When these investors were exposed to seeing the high-performance returns of their peers, they tended to take more risk and trade more actively. They also reported significantly lower satisfaction with their own performance. This connection between social comparison and trading behavior suggests a difficult psychological environment for many investors. When we look at these patterns together, the way social media attention is linked to trading activity, the way influencers set the mood, and the way seeing others wins pushes us toward risk, the question of agency becomes much harder to answer. We like to think of ourselves as rational actors, making calculated bets based on our own research. But in a digital environment designed to capture attention and broadcast success, it is becoming increasingly difficult to tell if we are driving the car or if we are simply being steered by the glow of the screen. If you've ever completed a trade on a popular smartphone app and seen digital confetti burst across your screen or earned a badge for your first transaction, you've experienced what researchers call hedonic gamification. It is a design choice that turns a financial transaction into a moment of celebration. This raises questions about the relationship between app design and user behavior. Do these features support long-term wealth building, or are they associated with higher levels of engagement? When researchers conducted a qualitative analysis of the interfaces of major trading platforms, they found that these platforms generally do not follow design patterns that encourage healthier trading behaviors, despite promising to democratize investing. The researchers noted that these apps allow users to trade stocks, options, and other securities easily, often commission-free. This design choice can have real consequences for people who are new to the markets. Researchers observing non-expert investors have noted that these apps can facilitate frequent, emotion-driven trading, where users may make decisions based on impulse rather than economic considerations. Rather than building a diversified portfolio, some users may make highly concentrated bets, a pattern that researchers note can lead to devastating, avoidable losses. In these moments, the line between a calculated investment and a high-stakes impulse becomes incredibly thin. However, the data suggests the answer isn't as simple as the apps are making us gamble. In a randomized online experiment, researchers looked specifically at how elements like confetti and achievement badges affect trading volume. They found that while these features do increase trading activity, averaging an increase of about 5%, the apps themselves aren't the only thing to blame. In fact, the study found that 70% of the difference in trading activity between gamified and non-gamified platforms was driven by user self-selection. In other words, the people who are already prone to high-frequency trading are the ones most drawn to these gamified interfaces. The design might be a magnet for certain behaviors, but it isn't necessarily the sole cause of them. There is also a nuance to how we receive information. We often think of notifications as helpful nudges, but their value depends entirely on whether we actually know what we're looking at. The research suggests that price trend notifications can actually help investors learn, provided their existing beliefs about the market are accurate. Now, for an investor who is already operating on a misunderstanding, those same notifications can act as a reinforcement, pushing them to double down on a mistake. Even the concept of gaming, the system can be flipped to promote better habits. In 2 small-scale lab studies, researchers tested something called an idle game, designed to encourage long-term, diversified investing. They found that this specific type of gamification actually worked in reverse. It reduced the urge to trade frequently and encouraged people to spread their risks more broadly. So, we are left with a complex tension. The digital tools that have opened the doors to the markets have also brought a new set of psychological hurdles. We are navigating a landscape where the interface is designed to be engaging, the information is designed to be immediate, and the person behind the screen is often trying to balance the desire for long-term growth with the very human impulse to chase the next burst of digital confetti. Where does investing end and gambling begin? It's a question that sounds academic, but for someone sitting in front of a glowing screen at 2 a.m, the answer feels much more visceral. To understand the line, we have to look at the tools themselves. Researchers have started using a specific term for a new breed of financial products, gamified investments. These aren't your standard index funds. We're talking about high-frequency trading and high-risk derivatives, products that rely on rapid-fire movement and the allure of those massive lottery-like wins. The math here is crucial. When you invest in a broad market, you're generally betting on long-term growth, where the math tends to favor the participant over time. But for these gamified products, that long-run advantage disappears. Researchers have noted that some of these products utilize design principles often seen in gambling, such as encouraging high-frequency use or providing the allure of lottery-like wins. In this space, researchers have observed behavioral trends where trading patterns are influenced more by immediate price movements than by the long-term prospects of a company. This design isn't accidental. A systematic review of research published between 2008 and 2025 suggests that digital interfaces and social media act as massive amplifiers for our most impulsive traits. We see a rise in herding behavior, where people move in a pack, and a surge in overconfidence. The review found that these technological elements, things like instant trading and gamified feedback, create dopamine-driven loops. It's a cycle of action and reward that looks remarkably similar to a traditional gambling environment. The data shows this isn't just a problem for beginners. While younger investors tend to adopt these digital platforms more aggressively, the research indicates that even financially knowledgeable investors are vulnerable to this kind of speculative behavior, particularly when they move into the cryptocurrency markets. In fact, one systematic review of 57 peer-reviewed studies found that approximately 9.5% of investors display what researchers call problematic trading patterns, behaviors that mirror the signs of gambling addiction. But it isn't just about the apps, it's about the culture surrounding them. If you look at the YOLO posts on subreddits like Wall Street Bets, you see a very specific kind of social environment. It's a culture that doesn't just acknowledge high-risk trading, it celebrates it. In these digital spaces, the language of gambling is used to normalize extreme financial risk. It turns a high-stakes gamble into a shared social experience, where the emotional connection to the group can actually encourage people to take risks they otherwise wouldn't. So, the line between investing and gambling isn't just a matter of how much money you lose or how much you win. It's about the intent, the frequency, and the design of the machine you're using. If you find yourself making high-speed, high-risk bets, sometimes accompanied by hedonic elements like bursts of digital confetti, the experience can feel less like traditional investing and more like a trip to the casino. But the casino has a way of following you home. When the markets are open 24 hours a day and the price of an asset can swing wildly while you're trying to sleep or sit down for dinner, the game never really ends. It becomes a constant, low-grade hum of tension. We see this tension manifest in very real ways when the market turns. In a study of over 300 crypto traders in Pakistan, researchers observed a high incidence of depression, anxiety, and stress during bear markets, those prolonged periods when prices are falling. Crucially, the study found that for those experiencing severe depression, there was a significant link to FOMO, or the fear of missing out. It's a punishing cycle. The fear of missing the next big rally is associated with higher levels of depression in some traders, and clinical observations suggest that market volatility may increase a person's vulnerability to symptoms of depression and anxiety. This isn't just about feeling stressed. Clinical reviews of high-pressure trading environments suggest that the combination of extreme volatility and the constant risk of financial loss can increase a person's vulnerability to serious psychiatric disorders. Psychologists point to several specific factors that make this environment particularly dangerous. There is the preoccupation of checking prices constantly and the anticipated regret of not having bought in sooner. There is also the danger of what researchers call identity fusion, where a person's sense of self-worth becomes so tightly wound up in their trading performance that a bad day in the market feels like a personal failure of character. When you add in traits like perfectionism or impulsivity, the psychological toll can be profound. This is why the conversation around trading is moving beyond just how much money did you lose, and into the realm of mental health and even legal responsibility. There are growing questions regarding the duty of care in high-stress environments, and whether the risk of self-harm in cases of catastrophic financial loss is a matter of medico-legal foreseeability. But it isn't all a downward spiral. There are protective factors too. The same research into trader mental health suggests that resilience is built through things like emotional regulation and strong social support. Interestingly, the study of those Pakistani traders found that people who felt they had high levels of support were significantly less likely to experience depression. It suggests that while the machine might be designed to keep us playing, the way we connect with others and how we manage the internal storm of the trade might be what determines whether we just experience a bit of market stress or something much more devastating. But as the community grows, the question of who actually holds the reins becomes much more than a debate about community guidelines. It becomes a fight over power, money, and the very nature of digital space. Take the case of Jaime Rogozinski, the founder of the Wall Street Bets subreddit. He is currently suing Reddit for $1 million, alleging that the platform wrongfully removed him as a moderator. Rogozinski claims the move was a pretext to seize control of the community and the brand he helped build. Reddit, however, tells a very different story, claiming he was removed for violating company policy by attempting to monetize the community and enrich himself. The scale of this community is immense. Since March 2020, the Wall Street Bet subreddit grew from 1 million subscribers to over 13 million. During the GameStop surge in January 2021, researchers observed a link between forum chatter on these boards and huge swings in share prices. But as the numbers grew, the control became contested. By early 2021, this friction turned into an internal revolt. A group of 9 former moderators decided they wanted to escape what they described as a broken, centralized system. They attempted to launch Wall Street Bets 2.0, a decentralized community built on smart contracts, designed to function without a central authority like Reddit. But even in a decentralized vision, the narrative remains fractured. One former moderator, using the name Jamzi, alleged that the subreddit's front page was being manipulated, specifically claiming that discussions about certain stocks, like GameStop and MMC, were being suppressed by the current moderation team. On the other side, a current moderator, known as ZZ, dismissed the move toward a decentralized site, characterizing it as an attempt to run a crypto scam. This tug-of-war between the people running the forums and the people using them highlights a much larger, structural shift in how financial information moves. We are moving away from a world where persuasion is handled by regulated, traditional intermediaries and into a landscape dominated by finfluencers. These are the personalities who live in your feed, individuals whose influence is amplified not by a license from a regulator, but by the algorithms that decide what goes viral. This creates what some legal scholars call a structural mismatch. Our traditional laws are built to regulate professional investment advice, but they aren't necessarily equipped to handle the rise of finfluencers. Research into finfluencers suggests they act as powerful intermediaries. Some data shows their sentiment predicts broader crowd mood, while other studies show a measurable spike in buying volume immediately after a YouTube recommendation. So, who is actually in control of the narrative? Is it the platform that owns the servers? Is it the moderators trying to keep the peace? Is it the influencers who command the attention of millions? Or is it the algorithm itself, deciding which voice gets heard and which one gets silenced? As the lines between social media, community, and the market continue to blur, the answer might be that no one is truly in control. And that uncertainty is exactly what makes this new frontier so volatile. This uncertainty often manifests as a frustrating paradox for the trader. You see the movement, you see the trend forming, and you're actually right about where the price is going. But when you check your account, the numbers are red. You were right about the direction, so why are you losing money? The answer often isn't found in whether your prediction was correct, but in the friction of the mechanics themselves. Take the world of options trading. It's a popular way to leverage a big move, especially around earnings announcements when investors expect a massive price swing. But research into retail options trading shows that many investors are essentially paying a volatility tax. Because everyone knows a big move is coming, the price of the option itself gets driven up. Investors often end up overpaying for the option relative to how much the stock actually moves. Then there is the bid-ask spread, the invisible gap between what a buyer wants to pay and what a seller wants to receive. In fast-moving markets, that gap can be enormous. When you buy and then quickly sell, you're essentially losing money to that gap every single time. When you combine those high costs with a tendency to react slowly to news, the math starts to work against you. One study found that retail traders in these high volatility environments see average losses of 5 to 9%, and that number can climb as high as 14% when the volatility is particularly intense. In these moments, research suggests that market makers, the institutions providing the liquidity, can become the primary beneficiaries of these retail losses. This feeling of being caught in a whirlwind is compounded by how volatility affects our behavior. In an experiment involving over 600 people, researchers found that when markets become highly volatile, people trade much more frequently. It's a pattern that persists even when you account for things like financial literacy or age. For some, especially those who already have a predisposition toward gambling, this volatility acts like a trigger, encouraging a cycle of rapid-fire trading that moves far beyond what traditional financial advice would recommend. Even the most sophisticated attempts to model these moments struggle to keep up. We saw this during the massive GameStop short squeeze in January 2021. While coordinated retail trading can certainly move markets, extreme volatility is a different beast entirely. It usually requires a specific storm of conditions, like very high short interest, to reach those heights. Even when researchers applied advanced machine learning models to these periods, the results were telling. Even the best-performing models often showed negative returns when tested against that kind of extreme, unpredictable movement. So, the right trade is only half the battle. Between the cost of entering the position, the price of the volatility itself, and the psychological urge to trade more frequently as the market gets wilder, the mechanics of the market can turn a correct prediction into a financial loss. In the digital age, the barrier to entry has never been lower, but the friction of the market remains just as real. But if the friction of the market is a constant, the speed at which that friction can turn into a wildfire is changing. We used to think of market movements as the result of slow, incremental shifts in value, thousands of individual decisions based on earnings, reports, or economic data. But today, there is a different kind of momentum, the momentum of the crowd. Researchers studying text data from the Reddit forum Wall Street Bets have documented a phenomenon that looks less like traditional investing and more like social contagion. They found that user sentiments about how an asset might perform are often motivated, in part, by what peers are saying. This creates a feedback loop where viral content can influence retail trader demand and impact future asset returns. The research suggests that this kind of idiosyncratic sentiment can contribute to bubble-like stock price run-ups, and that social media, in this way, can destabilize financial markets. We saw a massive version of this in January 2021, during the GameStop short squeeze. It was a period of extreme volatility where the stock price climbed more than 20-fold, causing significant losses for several hedge funds. This event was characterized by a tight link between intense discussions in online communities and coordinated trading activity. For some, this isn't even about the math of the trade. One commentator on the nature of these meme stocks argued that investing in them is essentially pure gambling, and that is precisely where the appeal lies. To some investors, a subversive sense of humor or an anti-establishment spirit matters more than traditional investment principles. But there is a concern about the systemic risks of this approach. There is a growing worry that meme stock investing may amplify broader concerns about the addiction, inducing properties of social media. If users of high-speed trading apps become caught up in these social media-driven cycles and incur large losses, the impact could be widespread. This volatility isn't always tied to a single rebellion either. Take Tesla, for example. Some analysts point to Tesla's extreme stock price swings as an emblem of a new kind of financialized capitalism. They argue that its market trajectory is shaped by a complex interplay of social media narratives, high volumes of derivatives trading, and a very public conflict between the company's defenders and its most vocal short sellers. When you combine these social media narratives with the ease of modern trading platforms, you get a system where the market can feel less like a weighing machine for value and more like a reflection of collective emotion. It raises a difficult question for regulators. How do you apply rules designed for a slow-moving traditional market to a digital environment where a single viral post can lead to a measurable spike in retail buying? This tension between empowerment and risk is perhaps most visible when we look at where these digital tools actually land. For some, the promise of decentralized finance isn't a theoretical debate about market efficiency, it's a practical response to economic instability. In Turkey, for example, researchers conducting ethnographic studies between 2021 and 2022 found that many people view cryptocurrency trading not just as a financial tool, but as a modern way to navigate a volatile economy. For these participants, it can feel like a viable alternative to traditional, state-regulated systems. But that shift comes with a heavy cultural cost. Many in Turkey perceive this trading as a game of chance, leading religious authorities like the Directorate for Religious Affairs to declare it impermissible. That feeling of playing a game isn't just a perception, it's increasingly baked into the interface itself. We know from randomized experiments that adding simple gamified elements, like digital confetti, is associated with an increase in trading volume of about 5%. However, researchers found that about 70% of the difference in activity was actually driven by user self-selection, meaning the platform simply attracted people who were already prone to trading more frequently. This blurring of lines between work, play, and investment becomes even more acute when the stakes are tied to survival. In Havana and Matanzas, researchers have looked at how play-to-earn crypto games like Axie Infinity have become a source of income for people facing severe economic crises. In these contexts, the distinction between a hobby and a job starts to dissolve, embedding financial speculation directly into the fabric of daily life. But there is a catch. These platforms often require significant upfront investment, and the scholarship arrangements used to help people get started can end up reproducing the same old patterns of class and inequality they were meant to bypass. When you layer this on top of the social media influence we've discussed, the landscape becomes incredibly complex. We see evidence that finfluencers act as powerful intermediaries. Some data shows their sentiment can predict the mood of the broader crowd, while other studies show a measurable spike in retail buying occurring just an hour after a YouTube recommendation is published. So, we are left with a profound contradiction. On one hand, we have a world where a massive short squeeze, like the one seen with GameStop in January 2021, can result in significant losses for hedge funds and major financial consequences for the market. On the other, we see a system where the tools of entry are often wrapped in the mechanics of a casino. The question for the next decade isn't just whether more people are participating in the markets, but what kind of participation it is. Are we building a more inclusive financial system, or are we simply exporting the risks of the old world into a new, digital, and much faster-moving arena? The answer may depend on how we respond to emerging research suggesting the lines between work and play, or between investing and gambling, are becoming increasingly blurred.